the 95% winning smart money formula. My guarantee is that after watching this video, you will never trade the same way again. You will learn in this training the 95% winning trading formula overlooked by 90% of traders, how to identify the most important pattern in the markets, and how to use this pattern to create the most effective trading plan. I want to reveal to you the most important pattern in the financial markets. The master pattern, which is made up of 3 market phases. Number 1, contraction, expansion, and profit-taking phase. Pay close attention to this pattern and focus completely, because this is the pattern that will change your trading for good. This pattern is happening on all time frames and in every financial market. Most traders will never spot this pattern. Why, you may be wondering. Can you see anything on this busy chart? This is how the average retailer's chart looks like. They've got moving averages, support and resistance lines, trend lines, and they end up covering their chart with so many different indicators. Stop cluttering your charts with a million indicators that will only confuse you, and you end up making bad trading decisions. Most indicators lag and repaint. Therefore, you only get the valuable information when it's too late. Traditional indicators and commonly taught technical analysis is designed to mask this important pattern so that you don't see it. This pattern is happening all of the time. This pattern affects everyone, whether they know it or not. This pattern gives you an exact trading plan that will never change. This is the exact system of the market makers and the banks. 90% of retailers lose money because they don't understand this pattern. You see, money moves from the masses to the smart money through this pattern. As you can see at the chart, the blue is the contraction, then we get the expansion, then we get the trend phase, and then we get contraction, expansion, and trend phase. And this cycle repeats itself over and over again. If you have a look at your charts, you will begin to notice these phases. The 5-star setup is: you look for contraction, you find the expansion. That is the signal to get ready to trade in the trend phase. I'm going to teach you a methodology on how to interact with this pattern in a hugely accurate way. First, you must understand this concept. Behind every trade placed in the market is a trader who believes they are going to win. Markets are belief driven. The current and future price is determined through the beliefs of the traders who are participating. It's beliefs that must be analyzed and not price. Pro tip: this is why most indicators don't work, because they are focused on price and not beliefs. These 3 phases make up a complete market cycle. Starting with 1, the contraction phase, this squeezing of price. This happens when there's low institutional volume and where the buyers and the sellers equalize. Then what happens? Price breaks out of this phase into the expansion phase and usually whipsaws above the box and below the box, which confirms this as our value line. The expansion phase is when we get increased institutional volume. You can always predict that after contraction, you will get expansion. Price starts opening up and it creates this whipsaw motion where the smart money accumulates positions at discounted prices. And then after this expansion phase, this whipsaw action, which is designed to liquidate the masses so that the smart money can accumulate positions, then we get number 3, the trending phase. This is when we have institutional profit taking. Once the market makers have accumulated enough positions, then they will decide to drive the price higher or drive the price lower, depending on what direction they want to move the market. Number 1, the contraction phase. This is the first phase in the market. This is where you get this squeezing of price, and it is identified by a higher low and a lower high. Understanding the first phase in the market is really about paying attention to when you see this high low and lower high. As you can see in these examples, price squeezes. As soon as it creates a high low and a low high, you draw a box around it. And that box will keep extending until price breaks out of that box. This is the reset point in the market where the banks and institutions plan their next move, and it usually forms indecision candles on the higher time frame. Here's an example of the whole process. We get this simultaneous higher low and lower high, the squeezing of price. We draw a box around it. We can draw a line out the center. This becomes our contraction line or our value line. It becomes an extremely significant level. You can see that price absolutely respects this level in all time frames, and it is an excellent barometer to predict where price is going to go. Contraction boxes. These boxes help you define expectations of upcoming market behavior. It serves as a leading volatility indicator because it lets you know what is going to happen next. These boxes provide you with the bank's starting accumulation point for their book of business. These boxes are the basic building blocks of all market framework that dictates future price movement. Another example, price comes into this contraction point, then it breaks out to the upside and whipsaws, breaks down to the downside. This is the start of the expansion phase. This lets you know that volatility is incoming. These levels also provide us with the point of control for the market makers, significant levels where they manage their book of business. As you can see, price is absolutely respecting these levels. And if you were to back test your charts, you will start to notice how price responds, reacts, and respects these levels. Number 2, the expansion phase. This is where price starts to expand outside of the box and create this whipsaw motion around the value line. This is what forms a range. But because it started at this contraction phase, it gives us a framework as to where this range is going to create swing high and low points around. Price likes to gravitate around these value lines. As you can see, price breaks above and below, confirms the line, breaks above and below and above, and then it starts to settle above here. This is where the institutional traders accumulate their positions. Expansion lines are the dividing point between market taker buying and selling pressure relevant to the time frame that is being observed. They provide exact price levels that make up the underlying framework of real buying and selling dynamics and gives a specific price where the market sentiment can change. Above expansion is increased buying, and below expansion is increased selling. It provides us with this predictable information. As you can see here, we've got the balance point, which is this contraction zone. Price breaks above and breaks below, and you can see it starts resisting the value line here. This is the exact point where the market maker's book gets heavy with sell positions, and this is what causes this selling pressure. Then price drops down, turns around, rotates, and breaks above the line again, and you can see it starts settling above this line. That is where we get this buying pressure. The market maker's book gets heavy with buy positions. Price breaks up again. As you can see, we've got this whipsaw up, down, up, down. Then we get this rejection into the value line, which is showing that price is settling above the value line. Expansion lines are a key factor in providing evidence against randomness in the market, which makes them a building block to constructing a successful market approach. Number 3, the third phase, which is the trending phase. After you get contraction, you get this whipsaw into expansion. Price decides to settle either above or below the value line. In this example, it's settled above the value line, and you can expect a massive movement away from the value line, which is where the market makers drive price higher or lower so they can start taking profit off their previously accumulated positions from the second phase. After the contraction comes expansion, then the trending phase. So you can see price squeezes, expands out, settles above or below the value line, and then starts moving to higher or low prices. This pattern repeats itself over and over again. Your effectiveness as a trader depends on your ability to recognize which one of these 3 phases you are in and then learn how to interact with that phase correctly. Dumb money are taught to read moving averages, Bollinger Bands, all kinds of indicators. I mean, there's hundreds of indicators out there. And what they don't realize is you're not trading against lines. You're trading against people, emotions, and beliefs. You need to understand how people's beliefs are going to be manipulated in the market in order to take advantage of these liquidity opportunities. By following smart money's business model of extracting that liquidity and trading alongside with their pattern of how they do business, this is the key to your continual trading success. The correct mapping of this pattern will help you understand the markets from an institutional perspective. This pattern is the footprint left behind by the bank's activity and how they do business. Now let us dive into the strategy section where I can show you how to trade with the master pattern for success. Let's first look at a short market. You only need 2 time frames, a higher time frame for your directional bias and a lower time frame for your entries. And these 2 time frames need to be a far enough distance apart from each other. A 4-hour and a 5-minute is an excellent distance. And how it works is we mark out our contraction box over here. We see price expands above and below it, which confirms the value line. And then we look for where price is settling. And we notice price is settling underneath the value line. You can see these rejections into the value line in this example. This is an indication to us that the market makers want to drive price lower. This confirms our short bias. Then we jump into a lower time frame to look for short entries. We come onto a 5-minute and we start marking out all the contraction boxes and expansion lines. And now we're looking for counter trend entries. We are entering our short positions when price is above the value lines. This would have been an entry, 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 and this would have been an entry. So you can see how this master pattern gives you this exact framework of when is the best time to enter a trade. Let's look at a long market now. You can see over here on the higher time frame, we've marked out the contraction box. Price breaks above and below, which confirms this value line. Then we notice price breaks above the value line and starts to reject into it. As soon as we get this signal, it shows us now that price is sustaining above the value line and that the likelihood of it going into the trend phase is extremely high and moving to higher prices. You can see over here as well, contraction, expansion, and we get this rejection into the value line. Once we can confirm that our bias is long, we jump onto the 5-minute chart and we start looking for entries below the value line. Our entries are always counter trend entries. As you can see, we could have got in below here, below here, below here, below here, and below here. It makes it super clear and easy for you to know where is the exact best moment to enter and catch that slipstream with the liquidity, which is the market makers.